What's going on, guys? Hope you're having an absolutely fantastic day wherever you are, as always. So on Wednesday, I teased that I bought a stock, and this stock is Alibaba, right? So in this video, I'm going to go through why I think Alibaba is very undervalued, my outlook on China's GDP, as well as my the price I bought, and also price prediction, right? So take price prediction with a grain of salt because no one gets that right accurately, right? So the first thing I want to cover is what price did I bought. So I bought at $127. So I actually have been looking at it since all the way back in October, right? So thank God I didn't buy there. But it's been trending down, 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 and now it's down almost 60% from the all-time high. So I bought and I'm already underwater, but it doesn't really matter. So I bought it at about $127. And you can see that in the past year, it's down 54%, right? So huge value destruction in terms of the share price, right? So fundamentals have also been deteriorating, but I don't think as much as the share price is reflecting, right? And by the way, if you don't notice, none of this is financial advice. This is just my own opinion. I'm just a random guy on the internet, right? So yeah, let's look at China's GDP for the first thing, right? So China's GDP, 14.7 trillion, huge economy, second largest after the United States. And if we look at the growth projections, right? So, I think in China's case, it's not going to be growing as fast as it did here, right? So this was like 10-20% growth, insane growth, right? But if you look at the projections, you can see that it's slowly teetering down, which is to be expected when it comes to the law of large numbers, right? Because if you look at 15 trillion, if you want the economy to grow 10%, you need $1.5 trillion worth of economic output in 1 year, right? So think of how hard that is to create, right? And that is why I think China's growth will be maybe 4 to 7% in the next 10 years, right? So since I bought, you have to brace yourself because Alibaba videos are coming, right? So those who love Alibaba will smash up the thumbs up button and hit the subscribe button and hit the bell button. But those that hate Alibaba will dislike my video. Thank God YouTube doesn't show the dislikes anymore because Alibaba has been a painstaking stock for a lot of investors. So next, I'm going to take a comparison of Alibaba and Amazon, right? So if we look at the gross margins, it's about 40%. And the EBIT margin is about 16.4%. So I need you to pause for a second and guess what Amazon's gross margin and EBIT margin is. Okay, 1 second has passed. So Amazon's gross margin is 25%. So this is still very impressive. And EBIT margin is 6.7%. So this is less impressive. But again, I'm not dissing Amazon or anything. It's a great business. And they are probably lowering their profitability to grow, right? But it's just for an example's sake, right? So you can see that Alibaba has higher gross margins and also higher EBIT margins, right? And why is this important? Because EBIT margin is basically what you get to keep, right? So if you have $100 billion in revenue, you get to keep 16 billion. Where else, if this Amazon has 100 billion, they only get to keep 6.7 billion, right? So you can see a huge difference there. So a lot of money that can be kept back to investors, paid as dividends, buyback stock, or reinvesting in the company itself, right? So this, if you look at the margins, right, you can see that it's been getting compressed in the previous years till up to now, right? So I think you should ignore all this, maybe these larger numbers, because basically, that is when they had no competition and also they just IPO'd, so maybe they wanted to juice up the numbers a bit, right? So you can see a more normalized would be about 20, I would say 10 to 25%, around that range would be a more normal EBIT margin range, right? So yeah, now we're going to take a look at my discounted cash flow model, right? So take it with a grain of salt because this is all estimations and predictions, and most of the time humans, we get this wrong, right? But I assume a 20% growth in the next 5 years, which is quite realistic because their management projection was actually 30% at the start of the year, but since the property slowdown is now, they are projecting 20 to 23%, which I think if the property slowdown passes maybe in the third or fourth year, they can grow even faster. So it averages down to about 20%, right? So 18% growth for the next 5 to 10 years, which I think is a bit high, but again, I still think it's quite realistic, right? So this is the best case, which is 27% and 25%, right? And the worst case is 15% and 10%, right? So I use all this and I average it out and I get a number here, right? So if you're wondering where I got this calculator, it's by a person called Sven Carlin. He runs a great channel on YouTube. Go check him out, right? Just type in Sven Carlin, you'll probably find him, right? It's a huge channel. So yeah, what is the numbers that I come up with? So I come up with $189, and I need to add the book value. So the book value is $52.50 per share. So I end up with $242. So that is the price. Under that price, I will be willing to buy the shares under that price. So you might ask, why did I wait so long until it's almost half of this price only I started buying? And the answer is very simple. It's because in one of my videos, I already thought out and quote unquote predicted that we will have a long time to accumulate these shares. What is the reason? The reason is because I don't think the pressures will subside overnight. And I think a lot of geopolitical tensions are still here, right? So as we speak, US is still threatening to delist Alibaba. So what are my price predictions? If I use this discount rate and change it to 11%, so 11%. So my price prediction is about $386. Why? Because this is what I think the fair value of the company is worth, right? So why do I put 11%? 11% because 6% is the real interest rates right now, right? So what are real interest rates? Real interest rates are basically the inflation rate minus the nominal interest rate, right? Which now real interest rate is sitting at about negative 6.1%. So I would use 6.1% plus the equity premium that I expect to receive, right? Because basically you have to beat inflation by 6%, only you're at break even. So which is the 6% here, and plus another 5% for the equity premium that you won, right? So that's why I come up to a discount rate of 11%. So that's why I estimate to be the fair value of Alibaba at $386, which represents an upside about 3 to 3.4x, I think. Yeah. So yeah, I'm going to put this back to 20% before I forget. So I use 20% because I want to afford myself a bit more of a margin of safety. And I also think that I will get a lot of these predictions wrong. So if I have a huge margin of safety, as I do now, let's say it's at $242, my price target, and I get to buy at $120. In a lot of cases, even though I'm wrong about a lot of things, I will still make money. So next, sorry, wrong slide. Yeah, next, I want to look at Alibaba's investment portfolio, right? So a lot of people will say, oh, you're investing in Alibaba, it's a black box, right? A lot of things that you don't know about, a lot of companies that are making losses you don't really know about. And I would say that this price has already reflected all of that, because if you have all of that on your balance sheet, right, and you still come up with a $9.11 free cash flow, right, which is we got it here. So a bit of lazy work is from last year, right? But basically, I expect this year's numbers to teeter out and average out eventually. So I think 9.11 is a good number to use. Sorry. And basically, if you are scared that you are buying something like that, I think that it has already been factored in the price there, and all the loss-making companies that will eventually become profitable and eventually IPO is all already baked into the price. So I don't really mind, because I have already paid for it, right? If I've already paid for it and it's already factored into the price, it doesn't really affect me. So last thing is the risk, right? I think this is a huge risk and everyone should pay attention to this, right? An end to IPOs by Chinese companies. Beijing is planning to close the loophole that led firm list, right? And this is basically the VIE structure, right? And I know everyone's going to say, oh, this is a risk that we already know about. Yes, I agree. I already known about this risk for the past year, for the past 2 years, but now it's becoming more and more higher chance that they are going to actually enforce and basically say that, oh, this is an illegal structure and what, right? So we have to pay very close attention to this, right? And basically, I think the markets reacted quite well to this, because if you can see that this was basically when the announcement was made, and Alibaba was down 3%, but only after the illness scare, right? Because the US had its first case, and basically it tanked Alibaba stock 3%, right? So before that, when the news was announced, actually there was no reaction. So I think the markets are taking it very well, because they are talking about only IPOs, right? So maybe the market doesn't correlate, but I think it's a big deal, right? Because they are using the same structure. So if you're banning one side, why wouldn't you ban the other side? So to me, it makes a lot of sense that if this actually materialized and this actually happened, Alibaba stock will also be affected, right? That brings me to the biggest risk, which is there is a chance that this VIE structure just is invalidated and everything just goes to zero. There is a chance. Currently, I rate it at about 5 to 10%. And previously that I rated it at about a 1% chance. So I'm not taking this very lightly. But I think this news came out at a very bad timing. Just literally maybe a few hours after I bought, this news came out. But I think I'm not selling out yet, because I think if this news actually comes out officially, you still have a chance to sell out, right? Because let's say a company like Didi, the regulators have come out and say that, the regulators haven't, but Bloomberg has come out and said that, Didi is going to get delisted, things like that. But the stock didn't tank to zero immediately, right? So with that being said, I'm going to take a look at in the future what happens. Calm down a bit, sit my ass down, and not overthink and panic, right? So yeah, that's all I wanted to share today. If you enjoyed the video, do help me smash up the thumbs up button, hit subscribe, and hit the bell button, right? And with that being said, hope you have an absolutely fantastic day ahead, and peace out.